Global oil prices have been fluctuating sharply in recent days over fears of supply disruptions. Oil climbed to nearly $120 a barrel before falling back after U.S. President Donald Trump sent mixed signals about the war with Iran and as G7 nations mulled releasing emergency oil supplies. We're joined today by Professor Kim Yong-Jin, professor at Sogang Business School. So Professor Kim, what's your take on the recent moves in crude oil prices and how is this affecting the global economy?
Yeah, good morning. As you mentioned, recently oil prices, have been on a wild ride. It has been primarily driven by the conflict involving Iran and the looming threat, Hormuz Strait blockage. Brent and WTI recently spiked, to 120 per barrel, which is the levels not seen since 2022. Before retreating to the low 90s. That followed hint of a massive strategic petroleum reserve release by G7 nations. I believe the oil price would be high for a while. It might cause a serious ripple effect like stagflation and high interest rate. If oil stays above $100, global GDP could drop by 0.4%. If it hits 150, we face a genuine risk of stagflation, which means stagnant growth paired with high inflation. If it happens, central bank may remain hawkish, potentially delaying the anticipated interest rate cut to combat energy-driven inflation. So the high oil price would hurt the global economy.
Right, and some analysts have said the continued closure of the Strait of Hormuz could push prices to $150 a barrel, but with oil prices dropping to around $80 a barrel recently, is it fair to say supply disruption fears and oil prices are under control now?
I'm not sure, it is fair to say we control the situation, but basically the drop caused by the wording of Mr. Trump, the war is very complete, pretty much. And the possibility of massive strategic petroleum reserve release by G7 nations, these two things influence the dropping of the oil price. So we have to see what comes next or how things evolve this week. My basic understanding is that oil prices, have the potential to spike significantly higher if the Middle East, crisis escalates further. Though a full-blown global recession is considered a risk rather than a certainty. The problem is that the risk has materially increased. For the U.S. and other major economies, a sustained price of $120 or 25 per barrel is often cited as a tipping point where consumer spending collapse and then inflation forces central banks to keep interest rate prohibitively high. This situation will cause stagflation. As households who are already stretched to breaking point by previous price hike struggle with a new energy shock.
I see. And here in Korea, the government is planning to impose a fuel price cap for the first time in 3 decades to shield the economy from an energy shock. Will this new measure bring down prices for consumers, and what are the side effects? How might this affect oil companies here in South Korea?
Yeah, recently, every media, covered a story of, the price cap, which is called the maximum price system, right? So the South Korean president and government all, announced his plan to implement the fuel price cap for the first time since 1997 price liberalization. So that's a long time ago. This emergency measure, which was rooted in the Petroleum and Petroleum Alternative Fuel Business Act, aims to contain a sharp spike in domestic gasoline and diesel prices, which have surpassed, 1,900 won per liter and triggered by the intensifying conflict in the Middle East. The measure is designed to provide immediate relief and improve price predictability by direct price control. It will prevent the gas stations from passing on global prices surges asymmetrically, means raising prices quickly but lowering prices slowly. It will come with some potential side effect, to my knowledge, including supply shortage, leveling up phenomenon, and the financial burden of government to make up the losses of those companies, and quality degradation. If government sets the cap below production cost of companies, refiners may reduce import or production to avoid losses, potentially leading to fuel shortages at the pump, and the quality of the oil might be degraded, and all gas stations may provide gas at the exact same price of the maximum price. So government need to come up with complementary measures like additional fuel tax cut and strategic reserve release and direct consumer support. And this kind of alternative measures are now being discussed by the government.
Right, and it's not just oil prices, because the Korean stock market has also been on a roller coaster recently. Why is this,
Right.
and how should investors respond?
Well, as you mentioned, the Korean stock market has entered a period of extreme roller coaster volatility as of March 2026. This primarily due to a combination of external geopolitical shocks and internal structural vulnerabilities. South Korea is facing a simultaneous surge in oil prices, the $1 exchange rate, which is approaching 1,500 won, the highest in 17 years, and inflation. Secondly, Korea is a major importer, energy importer. So Korea's economy is highly vulnerable to the U.S.-Israel-Iran conflict. On March 4th, the Kospi suffered a historic 12% plunge. It's the largest single-day drop ever, followed by a near 10% rebound the next day as the ceasefire and rumors emerged. Thirdly, the Kospi is, heavily weighted toward semiconductors and, shipbuildings. So, like Samsung Electronics and SK Hynix, the market capital of these two companies take 40% of whole market, capital. So, the centralization is too much. While their fundamentals may, remain strong due to AI demand, but they are the first to be, offloaded by foreign investors during global risk of episode. So, investors need to be very careful, even though looks like the market recovers, but still we have potential risk of the Iran, war. So we have to see what's going on this week at least. So you have to wait and see and rebalance your portfolio a little bit toward oil industries and war industries kind of.
Right. All right, Professor Kim, thank you so much for coming on this morning. We appreciate it.
My pleasure.